Do you understand the taxation trends in the crypto and stock market? It's a question worth pondering. In the ever-evolving world of finance, understanding taxation trends in the crypto and stock markets is not just important, it's essential. Why? Because taxation can dramatically impact your investment returns. It's not just about how much you earn, but also about how much you get to keep after taxes. So, whether you're a seasoned investor or a curious beginner, understanding these trends can significantly influence your investment decisions. Let's dive into the taxation trends in the stock market. When you invest in the stock market, you're not just buying and selling shares. You're also playing a game with tax implications. The way you manage your investments can significantly influence your tax obligations. At the core of this is the concept of capital gains tax. In simple terms, capital gains tax applies when you sell a stock at a profit. The tax is calculated on the difference between the purchase price, or cost basis, and the selling price of your stocks. But not all capital gains are treated equally. The tax rate you'll pay depends on whether your gains are classified as short-term or long-term. So, what's the difference? Short-term capital gains refer to profits made from selling stocks that you've held for 1 year or less. The tax rates for these gains are typically higher and are usually equivalent to your ordinary income tax rate. This could range anywhere from 10% to 37% depending on your income bracket. On the other hand, long-term capital gains come from selling stocks that you've held for more than a year. The tax rates for these gains are generally lower. For most people, the rate will be either 0, 15, or 20% depending on your income. A key strategy that many investors use is to hold on to their stocks for at least a year and a day. This way, they ensure their profits are taxed at the more favorable long-term capital gains rate. But remember, tax laws are complex and can change from year to year. It's always a good idea to consult with a tax professional or do your own research to understand the current laws and how they apply to your situation. The key takeaway here is that the length of time you hold an investment in the stock market can significantly impact your tax obligation. So, whether you're a day trader making quick moves or a long-term investor with an eye on retirement, understanding these taxation trends in the stock market can make a big difference to your bottom line. Now, let's shift our focus to the crypto market. In the world of finance, cryptocurrencies are still relatively new players, yet they've managed to create quite a stir, especially when it comes to taxation. For tax purposes, cryptocurrencies are treated as property, not as currency. This means that standard property tax principles apply to any transaction involving cryptocurrency. When you buy cryptocurrency, it's like purchasing a piece of property. You're not taxed on it right away. However, when you sell or trade that crypto, you generate a taxable event. If the value of the crypto has increased since you bought it, you'll have a capital gain and will owe tax on that gain. If the value has decreased, you'll have a capital loss, which could potentially offset other gains. But what about crypto mining and staking? These activities are a bit different. When you mine cryptocurrency, you're essentially creating new coins. The Internal Revenue Service, or IRS, views this as income and it's taxed as such. The amount of income is determined by the market value of the crypto on the day it was mined. Staking, on the other hand, is when you participate in a proof-of-stake crypto network by holding and validating transactions for rewards. The IRS treats these rewards as income too. The amount taxed is the fair market value of the rewarded crypto on the day it was received. It's also worth noting that if you're paid in crypto for goods or services, that's considered income as well. The amount of income is the fair market value of the crypto at the time you received it. From a taxation perspective, dealing with cryptocurrency can be complex. Each transaction needs to be tracked and the fair market value needs to be calculated for each taxable event. This is why it's crucial to maintain good records and consider seeking advice from a qualified tax professional. Remember, each action you take with your cryptocurrency may have tax implications. So, always be aware, prepared, and make informed decisions. Having understood the basics, how do these markets compare? When it comes to taxation, both the crypto and stock markets have their own sets of rules. Let's dive in and compare them. In the stock market, taxes are fairly straightforward. You pay capital gains tax when you sell your stocks, with the rate depending on how long you've held the stocks. The longer you hold, the less you pay. This incentivizes long-term investment. Now, the crypto market is a different kind of beast. Unlike stocks, every transaction in crypto, whether it's buying a coffee or swapping one crypto for another, is a taxable event. This means you could be facing a tax bill even if you haven't turned your crypto into cash. Determining the cost basis or the original value of your crypto can be a challenge. It's not as simple as with stocks where you have a clear purchase price. With crypto, the value can change dramatically in a short period, making it tough to figure out your exact gain or loss. Then, there's the task of tracking transactions. With stocks, your brokerage provides a detailed record. In crypto, due to its decentralized nature, you are responsible for keeping track of your transactions. Despite these challenges, it's crucial to remember that both markets are subject to tax laws, and ignoring them can lead to penalties. Despite their differences, both markets require careful tax planning and reporting. So, whether you're a stock enthusiast or a crypto pioneer, keep an eye on those tax implications. Let's recap what we've learned today. We've navigated the complex world of taxation trends in both the stock and crypto markets. We've seen that while they share some similarities, they also have their distinct characteristics. For stocks, the taxation rules are more established and straightforward. On the other hand, crypto taxation is still a new frontier with evolving regulations. However, both require diligent record-keeping and understanding of tax to avoid any potential loss. We've also the importance of staying informed about as the landscape continues to evolve, so too will the laws and regulations that govern it. Knowledge is power, and understanding these trends can equip you to make more informed decisions about your investments. Remember, this video is not financial advice. Always do your own research and consult with a financial advisor or tax professional. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notification so you'll get updates anytime we upload a new video.